We are online.
Okay, very good. Hello, everyone. Let's first of all make sure that you can hear and see us. So please type in something in the chat, like type a plus if everything is fine, and we should be able to see it in a bit, and then we will know that everything is working properly. So if someone sees anything in the chat,
it is. I see pluses.
Okay, that's very good. Let's then start. First of all, yes, my name is Viktor Kalgin, and I'm glad to see you among the participants to this webinar. And I'm joined by my colleagues who will be speakers to this webinar, Vsevolod Bude and Evgeniya Aleksandrova. So we are glad to see you. And before we start, I will tell a few. First of all, what we do. We are tax consultants, and we help our clients to develop tax-efficient international structures. This is what we do, and now we work in a new company called Global Aim, but we continue to advise our clients on complex international tax matters. About this event, we decided to make it relatively short and shorter than we usually conduct similar webinars, but we decided to make it broad enough to address various issues that affect tax planning strategy that international companies need to consider in view of tax developments in 2024 and 2025. So this is the plan. And I will explain or tell a bit more about the agenda in a few seconds. But two questions which are usually very commonly, two administrative issues. First of all, the most commonly asked question is whether the participants will get webinar materials, and the answer is yes. In a few days, we will circulate a recording of the webinar. And you will also receive on the email which you used when you registered to the webinar, you will receive the presentation. This is the plan. It's likely to happen early next week, so be patient, and you will receive a recording and the presentation of the webinar. This is one thing, and the second thing is you can ask questions. And I was glad to receive. We received some questions before the event, and we will address one of them at the end of the presentation. But you can type in your questions as we go, and we will either have some pauses and answer your questions, or more likely we will address them in the Q&A session at the end. So feel free if you think that something is not clear enough, please ask us, or conversely, if everything is very simple, please do not hesitate to ask a more difficult question, so that we address also complex questions that you face at the end of the webinar. That's the plan. And let me now turn to the agenda. And the webinar is planned for an hour and a half, and we will have several sections. In the first section, we will talk about Russian tax changes, and I hope that everything is working. Let me once again check that I can. Yes, I can list the slides, and you now should see the agenda. And the first section of the agenda will be Russian tax changes. We will obviously need to discuss increase in tax rates in Russia starting next year, and there are also some developments that affect international structures by eliminating some key structural tax incentives benefits, which need to be taken into account. We will then talk about profits tax, and the increase of the tax rate is the most obvious topic, but there are a few others. And the last section in the Russian part will be case law developments. We will talk about a few arbitration cases where which affected cross-border structures in specific circumstances in a dispute between the taxpayer and the tax inspectorate. The next section will be about Kazakhstan, and again there is a tax reform which is planned. We will talk about about it, and we see a lot of interest among our clients to the Astana International Finance Center, Astana International Financial Center, and Astana Hub. And we are frequently asked whether the benefits, the tax incentives there are going to be maintained. So we'll talk about this as well. And yeah, obviously, how to prepare to the changes and when they are going to happen will be addressed as well in the Kazakhstan section. Next, we will move on and turn our attention to the Gulf countries, specifically to the United Arab Emirates, which we work closely a lot over the last. We have been working with the United Arab Emirates over the last few years, and the ongoing tax reform is a constant point of our attention. Yeah, we will talk about new clarifications and guidances on corporate tax law, on corporate tax, as well as on other developments in VAT and economic substance requirements. And then the last part will be about global trends. It will be brief, but we will list a few trends that we see in other countries and globally as well. And finally, we will have a Q&A section at the very end. This is the plan. So stay with us for the next hour and a half. And now I should leave the floor to Vsevolod, because we will talk about Russian tax reform, and specifically about personal income tax and changes in this respect. And Vsevolod this is Vsevolod's area of specialization. So the floor is yours, Vsevolod.
Thank you, Victor. So, it is indeed my honor today to open our today's webinar, and I want to discuss today the tax reform which is now happening in Russia in respect of the personal income tax. As for the corporate income tax, this is going to be Victor's part, so he will return to this part later. So, as for personal income tax, interestingly, Russia is kind of in line with the international trends which are happening right now in the world, in the UK in particular, in Netherlands, where they thinking about amending the 30% rule, and in some other countries. So, I would say that there are generally four main or key amendments which affect personal tax and structures from 1st January of the following year. Some of them are applicable only for tax residents of Russia, and some of them may be applied to both residents and non-residents. So, the first one is the reform of the 5-year exemption on the sale of shares and stakes, or the participation interest. By the way, I will further elaborate on what is the difference between the shares and stakes in Russian legislation, so we'll get back to that a bit later. The second reform is the reform of the deemed income on the acquisition. It will apply not only to shares but also to stakes or the participation interest. Obviously, it is an increase in the tax rates. As you might know, in Russia it used to be 13 or 15%, and since January 1st of the following year it is from 13% up to 22%. But it is not that simple with application of these tax rates, and we'll try to learn more about this following amendment. And the last but not the least is the reform of the so-called fixed CFC income regime. It was extremely useful for those who was a participant in multiple foreign companies around the globe, because this regime allowed a taxpayer to pay only 5 million rubles in tax, but be resolved from the excessive compliance and calculations and etc. 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 So let's start with the first one, which is the 5-year exemption on the sale of shares and stakes. But before that, as I mentioned before, let's dive deep into the distinction between the company formations in Russia, because this is going to be the key in our following discussion. In Russia, they have two types of companies. These are АО or акционерное общество. This is generally a joint stock company, and the capital of such entity is divided into shares. And they have the so-called ООО, общество с ограниченной ответственностью, limited liability company. The capital of limited liability company is divided not into shares, but into participation interest or stakes. The point is, from the perspective of taxation, operations with shares and operations with participation interest taxed differently and viewed differently from the perspective of the Russian tax code. That is why there will be actually major differences between the tax consequences in relation to both of these types of companies in Russia. So, 5-year exemption. You might actually know this incentive because it was quite popular for the non-residents in Russia. So before the reform, it sounded the following way. Any capital gains from the sale of shares or stakes, well, with some exemptions to the property-rich companies, were exempt from tax if they had been held for more than 5 years. So, quite simple. Hold your shares or stakes for at least 5 years, and after that you will be able to sell them without any tax. Why it was crucial for non-residents who actually held a participation interest in Russian LLCs? You see, there is actually this difference in taxation which I mentioned before. The point is, how do we usually calculate capital gains? We take our income from the sale of our shares or stakes, whatever, and we deduct our historical expenses, the costs which we might have paid when acquiring when we were acquiring the participation interest. So, in Russia, these historical costs for LLCs are the so-called tax deduction. Tax deduction is a separate type of incentive which is allowed only for tax residents of Russia. Meaning that if you are a non-resident of Russia who was selling a participation interest in Russian LLC, you will have to pay tax on your gross income from the sale of the participation interest. You could not deduct any historical expenses or costs which you had when you acquired this LLC. And the cherry on the top is that the tax rate for non-residents on this type of operation is 30%. So that is why this 5-year exemption was actually the only way to achieve an adequate level of taxation in these types of operations. So, did it become better? Well, it did not. Because from January 1st, 2025, the 5-year exemption is retained only for tax residents. And even for them, it is limited by the income of 50 million rubles per year, which is approximately €500,000. So, since January 1st, non-residents of Russia executing operations with the shares, or not the shares, but stakes in Russian LLCs, will not have any measure to achieve the adequate level of taxation. This is what we have to keep in mind, and closer to an end, we will be back to the key solutions which may be implemented before the end of this year. And as you already guessed, one of them will be to sell your participation interest if you are non-residents of Russia before the end of this year. So, the second part of the reform. It is the deemed income on the acquisition of stakes. Before the reform, buying shares below the market would result in taxable deemed income equal to the amount saved. The point is, in Russia, they had no transfer pricing rules for individuals, only for corporations. That is why this concept of deemed income was a key element to compensate that. So instead of the transfer pricing rules, where we had to achieve the arm's length principle, we had the deemed income principle. Since January 1st of the next year, deemed income on the acquisition will rise not only in relation to shares, but also to stakes of the LLC. Interestingly, deemed income applies not only in the situation of the straightforward sales, but it might actually apply in the situation when you want to make a contribution to your company. Let's see the following situation. For example, you have an LLC in Russia. And you also have some assets which you want to transfer to your LLC. Your historical costs is $1 and the market value of these assets is $3 right now. You might, for example, sell these assets to your LLC. And in this particular scenario, you will have capital gains immediately because you sold your property, and you will have to pay tax on your capital gains in this situation from $2. But you could make a contribution to the capital of your LLC. And before the end of this year, it usually results in no tax because we have no deemed income on the contribution to the capital of the LLC and no deemed income on any operations with the stakes in an LLC. But since January 1st of the next year, there actually might be a deemed income tax in these types of operations, as we already have it in relation to shares of joint stock companies. Well, there are still debates on how to calculate your deemed income in this particular case, but nonetheless, we should articulate that there is a risk of the taxation of this operation. That is why it is a good idea to complete your contribution to the capital if you planned it for a long time and didn't make it until the current day. So the third part is of the Russian tax reform, as I mentioned before, is an increase in tax rates. And I would actually divide the types of income into two major groups. So we have types of income which are taxed by 13 or 15%, just as it was before. And we have a separate group of types of income which are taxed by 13 or 15 or 18 or 22%. In the first group, we should actually put mostly the passive income, which are the income on equity participation, including dividends, interests on bank deposits, and capital gains on the sale of securities and derivatives and your property. Interestingly, we should know that before that, property was always taxed by a flat rate of 13%. So since January 1st of the next year, it may be taxed by 15%. As for another types of income, they were taxed by 13 or 15% before, but we should note that the limit for 15% rate is lowered in half, from 5 million rubles to only 2.4 million of rubles. As for another group, we may put in this basket salaries, CFC profits, interests on loans. We should know that it is different from interests on bank deposits because interests on bank deposits are taxed by lower rates, and certain types of distributions not covered by equity participation. Interestingly, distribution from foreign trusts and similar structures, for example, Russian private funds, might be actually taxed by the higher rates because they represent themselves not a participation in an equity, but some type of another participation in a structure. So as for now, we have no, unfortunately, and that's quite obvious, clarifications on this issue, but we suggest following these in the future. And the last but not the least is the reform of the CFC fixed income. Before the reform, one could choose to be taxed on fixed income for all CFCs regardless of their amount and pay only 5 million rubles in tax. So, for example, as you can see on this picture, a taxpayer was holding 10 CFCs, 10 controlled foreign companies, and the only amount of tax he should pay in regard to these companies is 5 million in tax. However, also this special tax regime could provide actually significantly easier compliance, no calculations required, and no financial statements audits, with which the taxpayers now suffer from some difficulties in acquiring these audits, etc., etc., etc. Since January 1st, anyone wishing to use the regime must pay 5 million rubles in tax for each of the first 5 CFC and no tax thereafter. So we should pay 5 in our case where a taxpayer owned 10 different controlled foreign companies. He will be paying 5 times 5 million rubles, which amounts to 25 million. And after that, each additional CFC goes for free, kind of. So, what we all came here for today, in order to understand what can be done before the end of the year. And let's go again through all of these reforms which we discussed previously. So, 5-year exemption on the sale of shares and stakes. Before the end of the year, you could actually sell shares and stakes using the 5-year exemption. If you planned it for a long time, it is a good moment to finally execute the deal and use your exemption as it was formulated before. You could also transform an LLC into joint stock company. For example, if you are a non-resident of Russia and you want to retain your Russian stakes in a company, in order not to find yourself trapped in the situation which I described before, when you cannot actually divide any historical expenses in the event of sale of your company. You could transform your company from LLC to joint stock company in order to have shares and not a participation interest. As for the secondary form, if you are in the process of an acquisition of Russian LLC, you could actually finalize the acquisition of these before the end of this year. It is a good idea, especially if the price in this deal is different from the market one, because since January 1st, you will have to apply the deemed income concept. And if you were planning to make a contribution to your LLC, it is also a good idea to finalize this contribution before the end of the year. As for the tax increase, in tax rates, you could actually evaluate your cash flows which you have right now. This is a good idea because of these two groups of different tax income which are taxed differently. So, for example, you could go in the next year without a salary or without an interest on loan, but you could substitute that by dividends or capital gains. And in this by this measure, you will be able to optimize your tax burden and stay within the lower tax brackets. As for the fixed income, it is an interesting one, and I suggest evaluating whether to continue using the fixed base regime for your CFCs. If not, you will be able to file the notification that you do not want to apply this regime anymore before the end of the next year. There is a grandfathering provision in the tax code of Russian Federation saying that if a tax burden within your fixed income regime becomes higher, then you are able to leave this regime. So if you decide not to use him anymore, not to use it anymore, it is a good idea to file this notification because it doesn't happen automatically. If you still consider continuing applying this regime, you could, for example, simplify your structure in order to pay only for one company or only for two companies, but not for 5 companies in your structure if they happen to be there only historically and you don't need them anymore. And one bonus strategy for before the end of this year. Let me remind that before the end of this year, you might receive assets from your CFC tax-free. We actually described this measure in our previous webinar, so this is the screenshot from there, and you could watch this webinar or you can email me at my working email address and I will be able to send you the presentation from our previous webinar and maybe even a link to the recording of this. So I guess this is it on my part. So let me pass the scene to Victor, and he will continue discussing the profits tax in Russian Federation. Victor?
Yes, thank you, Vsevolod. I hope that everything is working properly, but let me check just in case. So please type in pluses or something, or make a sign to me that you can hear and see me, so that we'll make sure that everything is working properly. Yes, I can see pluses. Very good, very good. Thank you, thank you. Let's continue. I think I should now make sure that I can list the slides. Yeah. It looks like we need to switch to the profits tax section. Just stay with me. just a few seconds more, and we will continue. Aha, so here we go. Profits tax and developments in this respect. Okay, so the obvious change starting next year is that the profits tax rate in Russia is going to increase. It will increase by 5 percentage points. Currently, until the year ends, it's 20%. Starting next year, it's going to be 25%. This is a significant increase. This increase by a quarter, which is really important for companies that pay Russian profits tax at a normal rate. Exemptions exist. There are special regimes in Russia, but the headline rate increases. It also affects withholding tax rates. And this is less obvious, but withholding tax rates are also considered profits tax. Withholding tax is also part of the profits tax chapter in the tax code of Russia, and the increase in profits tax affects some withholding tax rates. For dividends, the good news is that for dividends, the tax rate remains the same. It's 15%, and again, it can be reduced by an applicable double tax treaty, but the domestic rate is 15%, and it's going to stay the same next year. But for interest and royalties, the increase in the headline rates will affect withholding tax rate as well. So this year, interest and royalties are still subject to withholding tax at the 20% rate. Next year, it's going to be 25%, which is a significant increase. And intergroup services, that's subject to withholding taxation in Russia starting this year. The tax rate is going to remain the same, 15%. Okay, so this is important. The increase will also affect, there will be increase in taxation of IT companies, which rely on specific reduced income tax rates, which is currently 0. Next year is going to be 5%. This is simple, but the solutions or the ways how to address it may be different and depends on a particular situation. But what you can consider, three things to consider before the year ends, in light of before the headline rate increases. First of all, where it is possible, a company may accelerate recognition of income, which is added to profits that are subject to lower tax this year compared to increased tax next year. This is why, if you can, in one way or another, accelerate recognition of income where it is justifiable, you will improve your effective tax rates. The company can benefit from the reduced lower tax rate this year. And the same applies to deduction, but vice versa. If you can delay the deduction of expenses until the next year, the tax effect will be higher, because obviously the expenses are going to be deductible against a higher profits tax rate. This is one thing. Second thing, losses can be utilized next year or later instead of utilizing them this year. Company can, and this is a right of a company to utilize accumulated losses. So if you have losses, consider saving them for the future when they can be deducted against profits that is taxable at a higher rate. And finally, given the increase in the rates of withholding tax for interest and royalties, you can accelerate if a Russian company has interest or royalties debt to a non-Russian entity, and you expect that it's going to be subject to the domestic rate, no treaty applies, for example, then you are better off paying interest and royalties, paying the debt for interest and royalties this year, because again, the withholding tax rate is going to be lower. Or even if you apply a double tax treaty, there is always a risk, and we will see this in the case law section, that the Russian tax authorities challenge the application of the treaty benefits and the reduced withholding tax rate, in which case, even if you apply double tax treaty, you can still, where possible, pay interest and royalties this year, so that the risk, that your exposure is taxable at a lower rate. So this is something to consider. Again, each structure, each situation is unique, as we help companies develop efficient tax strategies given their particular circumstances. But this is something, these are three things that can be considered in view of, in anticipation of the increase in the profits tax rate and withholding tax rates next year. To wrap it up and close off the section about legislation changes, about tax changes in law in Russia starting next year. First of all, most changes come into effect from the 1st of January 2024. And there are three main laws that are listed on these slides and can be reviewed more carefully that introduce these changes. Again, after you receive the materials of this webinar, you can look up more closely these laws and assess how they affect your structure. The laws are obviously in Russian, but you can follow the links. And these days, automatic translation does wonders. So even non-Russian speakers can review the changes using automatic translation, but just as an idea. Obviously, we can help, but okay. So these are the laws that introduce the changes. Let's move on. And the next section is Russian case law developments. And we will look at three arbitration cases where cross-border structures and specific tax consequences were disputed between the tax authorities and the taxpayer. The first case relates to application of a reduced withholding tax rates, in particular in respect of interest. And you on the slides can see the structure, how it was, the structure where there was a Russian company that paid interest to a non-related party in Singapore, which was owned by a parent company registered in the Cayman Islands. And the Russian company, it applied. It was a bank. It is a bank, and it applied reduced withholding tax rates under the Russia-Singapore double tax treaty. But the tax inspectorate challenged the treaty benefits, saying that based on the response from the Singaporean tax authorities, whom they asked about this transaction, that the lender, the Singaporean company, was actually an agent or an intermediary or a conduit entity. And in fact, the interest was supposed to be received, and then the beneficiary of the interest was the parent company registered in the Cayman Islands. This is why, since there is no double tax treaty between Russia and the Cayman Islands, the Russian tax authorities challenged the treaty benefits and charged withholding tax rates on interest based on the domestic rate of 20%. The case developed, and the first instance court and then the following instances sided with the taxpayer and said that given the information that the non-related party, non-related lender presented to the Russian bank, it was the ultimate beneficiary of the interest, and this is why the application of treaty benefits was justified. However, the case was disputed by the tax authorities in the Supreme Court, and the Supreme Court sent the case back to the first instance court for reconsideration, saying that attention should be paid to the response that the tax authorities received from the Singaporean tax authorities, basically saying to the lower instance courts to revise the decision. And the decision was indeed turned into its opposite, and the courts one by one sided with the Russian tax inspectorate, saying that based on the information that's available, that the Singaporean company was the agent and was not eligible to claim treaty benefits. And this is concerning because obviously the taxpayer, the Russian bank, was not able to ask questions to the Singaporean tax authorities and was presented with information which it relies upon from the Singaporean lender. But unfortunately, the response that the Russian tax authorities received from their authorities was different, and that was basis for the claim. And unfortunately, the courts sided ultimately with the tax inspectorate. It was negatively decided in favor of the Russian. It was decided in favor of the Russian tax authorities, which is, as I said, disturbing, because the Russian bank couldn't probably have known that the Singaporean company was not the ultimate beneficiary, was not the principal, was not the ultimate lender of this loan. Okay, next case, which is a positive one, relates to an exemption that was relied upon by a Russian company which borrowed money from its parent company. You can see the structure on the slide. It's pretty simple. There is a Russian parent company. It's a domestic case. There is a Russian parent company and the Russian borrower. There was a loan which was used by the borrower, by the subsidiary, to cover current expenses. But due to financial difficulties, the parent company, the loan was forgiven, and the parent company didn't receive it back. But the subsidiary, despite the loan forgiveness, is technically is income. It results when debt is written off, then it results usually in income in the accounting statements. But from tax perspective, there is an exemption for basically for assets that are transferred free of charge between the parent company and the subsidiary, provided that the participation is at least 50%. And this incentive was relied upon in this case. And it's for years it was customary for taxpayers to rely upon this incentive. But unfortunately, last year the Russian tax authorities kind of changed their view on this incentive, saying that it is not applicable to forgiveness of loans, saying that loan forgiveness is a separate transaction and there is no transfer of assets when the loan is forgiven, which means that technically the incentive does not apply, which technically has its grounds. But before the change last year, the tax authorities continuously, and the Russian Ministry of Finance continuously supported the application of this incentive to loan forgiveness. But the practice changed. But fortunately, in this particular case, despite the tax inspectorate claimed that the incentive should be denied, the court supported the position of the taxpayer. It's always hard to specify the most significant reason why the court decided in favor of the taxpayer. And we will see in the next case that it's not so obvious that in similar situations, courts will support taxpayers. But yeah, the judges found evidence that provided that the taxpayer, the subsidiary, was providing to them convincing and supported the taxpayer, which was unfortunately not the case in another cross-border dispute, which we'll look into in a second. Yes, so there was another case which was negatively resolved in favor of the tax authorities, where there was a Cypriot lender which provided loan to the Russian borrower. And there was another complication, another Cypriot company, which had its claim, a receivable to the Russian company, which was transferred to the parent company, and ultimately both debts were forgiven. And obviously, in this situation, the Russian subsidiary the debt was consolidated to the Cypriot parent company in order to claim the benefit, claim the exemption upon the forgiveness of these debts. Yes, so after the parent company kind of consolidated all the debt to the Russian subsidiary, it again forgave the debt, and the Russian subsidiary didn't tax the income on loan forgiveness by claiming the exemption, which was which allowed assets transfer between the subsidiary and the parent company to be transferred tax-free without taxation. Unfortunately, the tax inspectorates viewed this set of transactions as fictitious, and the chain of transfers, the chain of assignments of debt between separate entities, which were only carrying out mainly financial transactions. And in view of the tax inspectorates, there were no business purpose in the restructuring and in the assignments of debts. And at the end of the day, that was the reason to deny the exemption, and the court decided that the tax inspectorate was right. Again, it's hard to say which factor specifically resulted in this outcome. Probably multiple factors affected the decision, and not the least, I think, although there is no the exemption is available regardless whether the parent company is a Russian company or a non-Russian entities, as we see in this case. The only obstacle for non-Russian companies to use this exemption is where they are located in a country that is blacklisted by the Russian tax authorities. Cypriot at the time when the debt forgiveness was made was not blacklisted, and but nevertheless, since the Russian tax authorities, they scrutinize cross-border transactions, one of the reasons maybe to deny the exemption could have been that this is a cross-border situation, and the court decided in favor of the tax inspectorate. Okay, what can be done? What are the things that can be considered? Two things in view of these case law developments. First of all, it may be a good idea to check more carefully counterparties, especially in other countries, and if the amount is significant. Russian double tax treaties still exists, despite almost 40 double tax treaties over the last couple of years were either cancelled or suspended. But there are existing double tax treaties, for example, with Hong Kong, with Turkey, with other countries. And if your counterparty is located in one of the treaty countries and you claim treaty benefits, it's a good idea to carefully check whether this counterparty is eligible to treaty benefits, and double check that it's not a conduit company and it's not an agent representing another entity which is located in a non-treaty country, which was the case in the first case that we considered between Russia and Singapore. And second, if you are planning a restructuring, then probably loan forgiveness is not as good idea as its repayment with some other subsequent steps in order to make the restructuring happen. Payment is usually better than non-cash than a non-cash transaction, because as you saw, loan forgiveness is now often challenged by the Russian tax authorities, and income is imputed by the Russian tax authorities in case the exemption for transfer of assets between the subsidiary and the parent company is claimed. Okay, let's now turn our attention to Kazakhstan, and there is a planned tax reform there as well. We will look at it briefly, but a few months ago, a draft tax code in Kazakhstan was published, and there is a link. You will be able to follow it. There is still a draft code being published in Russian, and initially it was supposed that the changes were going to come into effect next year. So from 2025, we should have had new tax codes in Kazakhstan. But in September, in the presidential address, it was proposed that the discussions continue next year about the planned tax reform, So now it's unlikely that the changes will happen next year. Most likely that the amendments that were proposed in June are going to take place and come into effect from 2026. But still, and this means that we have more time to prepare. What can happen? Let's look at what 5 key changes may affect international structures with assets in Kazakhstan. First of all, the good news is that withholding tax rates mostly remain the same. The base withholding tax rates for corporate income tax is 20%. 15% applies to capital gains, dividends, and interest, as well as royalties, and 20% is used for blacklisted countries. So this is good news. There is no increase. At least it is not planned. It was not planned to increase withholding tax rates for major types of income. There is also good news. The domestic dividends withholding tax rate is going to be reduced to 5%, provided that the ownership is at least 25%. For strategic investors, the withholding tax rate is supposed to be reduced from 15% to 5%. It's not uncommon for Kazakhstan to have a double tax treaty with a particular country that allows using withholding tax rate for dividends of 5%, sometimes 10%. The double tax treaty, for example, between Russia and Kazakhstan reduces withholding tax rates for dividends to 10%, but 5% is not uncommon. But to apply tax treaty benefits, obviously, it's necessary to confirm that treaty benefits apply. And especially problematic were rules that in intragroup transactions, in order to apply treaty benefits at source by the tax agent, it's necessary to demonstrate that this income is subject to a tax at least at 15% in the country where the income recipient is located, which is not always the case. And for example, especially for dividends, it's very common to exempt for countries to have exemption in respect of dividends that parent companies receive. In Russia, 0% applies to participations and dividends that are received. Basically, if the participation is long enough, exceeds 1 year, and the participation share is at least 50%, and which means that even between Russia and Kazakhstan, if dividends are paid, this subject to tax test does not apply specifically to dividends, which means that even not the ideal 10% withholding tax rates is it doesn't mean it doesn't apply. It means that the tax agent is not able to apply the reduced tax rates, and it's the Russian parent company should come to Kazakhstan and refund the excessively withheld dividends tax of 5%, which is the difference between the domestic rate of 15% applied by the tax agents and the 10% allowed by the treaty. And this refunds is a complicated story. Doesn't always happen. This is obviously problematic. This is why one can only welcome the reduction of the domestic withholding tax rates in respect of dividends to 5%, and that 25% participation is easily achievable. And for strategic investors, it's obviously a welcome change. It's unfortunate that we'll have to wait until 2026, and one of the decisions we'll come to this later would be to wait until the change comes into effect and postpone distribution of dividends. Okay, next, the third change, which was supposed to be made, is that the 3-year tax exemption in respect of dividends. It's not exemption, it's now incentive. There used to be a 3-year exemption for dividends in Kazakhstan. Now it's just a reduction of rates to 10%. Well, the plan is to eliminate it if the changes come into force as they were planned in June. But it's a good trade-off for the reduction of withholding tax rates to 5% for strategic investments. Okay, so this 3-year reduction, 3-year incentive is supposed to be eliminated. Next, The good news is that the 3-year exemption for capital gains is supposed to be maintained. And yeah, there were rumors that this 3-year exemption may be abolished, but it doesn't look so from the draft tax code which was published. We will have to wait and see, but hopefully it will be it will remain. And finally, the subject to tax test, which I already mentioned, is going to be eliminated. And as I said, it's not always easy to demonstrate that the income is subject to 15% in the country where the income recipient is located. So this is a welcome change as well. Okay, so here are the 5 changes that affect international structures in with assets in Kazakhstan. Let's now spend a couple of minutes to discuss planned changes in relation to Astana Financial Center and the Astana Hub. Well, basically, it was announced that the AIFC tax benefits must remain in place. But yeah, there are rumors that there have been rumors over the last few years that the tax benefits in the AIFC may be changed or removed altogether, but it doesn't look so now. Currently, the plan seems to be to keep these incentives. And in the Astana Hub, there is also an intention to reduce the threshold for income from so-called priority types of activities to lower the threshold for the requirement for this income from currently 100% to 90%, which means that companies will be able to keep their tax benefits that are provided to the Astana Hub participants, even if they receive some incidental income, which is not strictly speaking falls under the definition of priority type of activity, the priority type of income for the Astana Hub tax incentives. And finally, there is a plan to reduce or to cut down the tax incentives for funds that are registered in the AIFC, which receive income from real estate. So this is a narrow niche, I suppose, but there are such funds. The good news is that other funds, which we see in practice used relatively commonly, other funds will be able to use the exemption that is provided in the tax code itself, not in the constitutional law, not in the AIFC constitutional law, but yeah. So the plan is to narrow down the application of the exemption for AIFC funds, but do not remove it completely, which is relatively good news as well. Okay, so what can be done? One obvious thing is if the changes are going to take place in 2026 and they are going to take place as planned, the 5% domestic rate for dividends looks beneficial, and it may make sense to postpone the distribution of dividends, which may now be subject to, let's say, 10% under the Russia-Kazakhstan double tax treaty until 2026, when they can benefit from the domestic 5% withholding tax rate. And just in case the 3-year exemption on capital gains is cancelled, one can consider restructuring that uses this incentive, this exemption, and changes the structure in a way that this exemption is not critical for the structure in the future. Okay, so we'll have to wait and see how the tax reform in Kazakhstan develops. Again, the most likely scenario is that the changes will be discussed next year and will come into force from 2026. Okay, let's now continue and look at the Gulf countries and the United Arab Emirates and tax developments there. And now I should wait for Evgeniya, who will continue the presentation. Yes, we can see you, Evgeniya. Please move on. We can see you, but we can't hear you. You should turn on your microphone.
Okay, now you should hear me. Can you?
Yes.
Okay. Yes. Thank you, Victor. And hello, everyone. In this block, we will cover recent key tax development in the GCC countries. Oh, wait a minute. They include new taxes, incentives, tax treaties, and also some new clarifications in the UAE. We'll start with Bahrain, tax changes in Bahrain. This September, Bahrain has issued a law which introduced a 15% domestic minimum top-up tax for constituent entities of multinational enterprises situated in Bahrain. And the new tax covers those groups whose annual revenue is higher than 750 million euros. In 2 of the last 4 fiscal years. And also based on statements of public figures, we're expecting to see a draft legislation for incorporation of corporate tax in Bahrain till the end of this year, and we're waiting for it to be effective in the near future. Talking about Saudi Arabia. So almost 10 years ago, Saudi Arabia has implemented a program called Vision 2030. It's quite a complex program, and tax issues is not the main focus of it, but still there were some tax incentives and tax regimes that were implemented as a result of this program. One of it is the establishment and the creation of special economic zones. As for now, there are 5 such zones, and from our information from local partners, they do not actually function properly right now. They're just kind of in the development stage, but when they are, the residents of these zones will have access to 5 corporate tax rate, 0 withholding tax on profit distribution, some other VAT and customs incentives. Also, in this year, incentives for regional headquarters were implemented. Such taxpayers are allowed to use, no, not allowed, but are exempted from corporate and withholding taxation for 30 years. Also, it's not a tax reform, but Saudi Arabia has loosened the requirements for foreign participation and local employees. That's, yep. And Oman, in its turn, has issued draft legislation for the implementation of personal income tax. The rates will be from 5% to 9%. And as you may see from the slide, there are some revenue thresholds that should be exceeded in order to be subject to income taxation. Kuwait and Qatar has ratified and signed some tax treaties. For example, Kuwait has ratified a tax treaty with the UAE, and Qatar has signed tax treaties with Saudi Arabia and the UAE. We're still waiting for the text of this treaties to be published, and as of now, we do not know their content. But as for the tax treaty between Kuwait and the UAE, it imposes 10% withholding tax on royalty and fees for technical services, and also grants exclusive right of dividend and interest taxation to the state of residence. And we move into changes in the UAE. Recently, there were some updates in its tax legislation. In particular, on October 6, a new version of the executive regulation to the VAT law was published. Most of its provisions are effective as of November 15, 2024, with some exceptions. And it has overall, there are more than 30 amendments. Some of them you may see on the slide. For example, the definition of virtual assets was introduced, and and this definition should cover cryptocurrencies and crypto assets. And some arrangement with the virtual assets should be exempt from taxation. For example, transfer of ownership or keeping and managing of such assets. Also, the definition of management of investment funds was introduced, and such services are also exempt from taxation. Also, the new decision provides more clarity on documentation needed to apply zero rate for export, and there are just a lot of different amendments in taxation and compliance. And taking into account that these changes are very considerable, we urge the businesses to pay attention to them in the following months in order to see how they affect businesses. Mm-hmm. And as many of you may know, the UAE has two types of substance requirements. So the first one is imposed on qualifying free zone persons for corporate tax purposes. And the second one is just a general economic substance requirements for some types of activities, and it doesn't in any kind affect taxation of businesses in the UAE. But the news recently emerged that these general substance requirements will be cancelled, and it will be cancelled retrospectively for financial years which ends after December 31st, 2022. And the important thing is that all the fines that were imposed since 2023 should be refunded and cancelled. And now, moving to updates in the corporate tax. So the UAE Federal Tax Authority has recently issued a few very important clarifications, including the corporate tax guide about taxation of free zone persons. This guide provides an overview of requirements that persons should meet in order to be recognized as a qualifying free zone person and to apply zero corporate tax rate. And it just provides a lot of examples on different issues that were not as clear before the issuance of this guide, just using the corporate tax law. And the guide is more than 100 pages long, so we'll cover just few key clarifications. And first of them is that the guide clarified that if a free zone person doesn't derive any income, it should not lose its status as a qualifying free zone person. But if it doesn't derive any qualifying income and derives any sum of non-qualifying revenue, it should lose its status for 5 consecutive tax period. As an example, in the guide, there is an example in the guide. So a company in its first tax period sells a chair to an employee and derives this kind of income that cannot be recognized as a qualifying income. And in this case, a company should lose its status as a qualifying free zone person and cannot apply the zero corporate tax rate for 5 years. And the similar approach is applicable when a taxpayer chooses to pay 9% corporate tax rate or is just silent about his choice of whether he wants to pay a zero corporate tax rate or if he wants to pay zero corporate tax or 9 corporate tax. And as I mentioned earlier, substance requirements are imposed on qualifying free zone persons. And these requirements raise many questions because the law and the tax legislation doesn't provide specifically how many employees, assets, expenses should a free zone person have in order to fulfill the substance requirements. And in this regard, the guide clarified that a free zone person cannot use one employee to conduct different qualifying activities. So the basic rule is one employee should conduct only one qualifying activity. And for example, as you may see from the slide, if a company is engaged in distribution and treasury activities, it may not employ one person to do all the work because in this case, the company may not apply zero corporate tax rate, and it should apply a 9 corporate tax rate in relation to income from distribution and treasury activities. But if a company have different employees for distribution activities and treasury activities, it may it may be recognized as a qualifying free zone person and applied the zero corporate tax rate in relation to the income from these activities. And here I also want to stress out that according to law and the guide, only full-time employees are considered accounted when assessing whether the company meets the substance requirements test. So a company may not employ only part-timers. It should employ at least one full employer, but you should take into account the nature of businesses, amount of transaction, and other important factors. And there is one exception from this rule about having at least one full employee. The substance requirements for holdings are quite relaxed. The FTA clarified that if a company is engaged in holding activities, it doesn't need any employees if all the decision making takes place in a free zone. So a company should fly all its directors to the free zone in order for them to make decision about the operational activities of the company in this free zone, and there should be evidence that the decisions were made in a free zone. Talking about the incentive for distribution of goods and materials in or from designated zone. So before the guide was published, there was an assumption that that in order to use this incentive, the goods should enter the UAE territory, should be imported into the designated zone. However, the guide clarifies that the goods may never enter the UAE territory. So the goods, like the supplier and the purchaser of the goods may be foreign entities, and the supplier can transport the goods to the purchaser directly. And also the guide stresses out that the purchaser should not be its end user, and the distributor, the trader in a designated zone, should have evidence to prove this fact to the authorities. And also talking about the incentives for distributions in designated zone, I want to stress out that not all free zones are considered designated zones for corporate tax purposes. For example, a DMCC, which is quite popular zone for traders, is not a designated zone. So if a trader is established in DMCC, he actually cannot use this incentive that we're talking about. So it's very important to choose free zone carefully for the trader. And yes, and also the guide has provided some unexpected clarifications. For example, the guide states that putting money on bank deposits is considered a qualifying activity. It is considered a treasury and financing activity. And as such, interest income from bank deposits may be exempt not exempt, but zero tax rate may be applied to this income. And since recently, we have many requests from clients with questions about permanent establishments. Thus, I want to cover two important issues in this theme. First of all, a qualifying free zone person and its permanent establishment, whether it's foreign or domestic, they are considered related parties in the UAE. And as you may know, to be recognized as a qualifying free zone person, a person should comply with transfer pricing rules and prepare all the necessary transfer pricing documentation. Thus, all the arrangements, agreements, and transactions between a free zone person and its branch should be at a market level. For example, free zone person may not provide non-interest loans or financing to such branch because it may result in his loss of status for 5 years. And also, it should be noted that when assessing the de minimis requirement for a free zone person, the revenue which is attributable to a permanent establishment should not be taken into account. And the last but not the least on my part, the UAE also has issued clarification on first corporate tax period. This clarification kind of clarifies how to determine the first and following tax periods for taxpayers. In particular, it clarifies that first tax period may last from 6 months to 18 months, but the following period should last for 12 months. Also, there is an obligation to register for corporate tax purposes, even if a taxable person ceases during its first tax period. And also there is an obligation to submit a tax deregistration application within 3 months after the cessation of a taxpayer. And also it's not depicted on slides, but the FTA has postponed some deadlines for filing of tax return and payment of the corporate tax for some taxpayers until December 31st, 2024. The taxpayers that are covered are those that were established on or after June 1st, 2023, and whose first tax period ended on or prior to February 29th, 2024. And yes, that's all on my part. So I'll give the floor to Victor.
Yes. Thank you, Evgeniya. Yes, let me check that everything is working. I hope that you can see me and hear me. And let me check if I can control the screen. It looks like I can. Okay, very good. Let's move on. And by the way, I can see that there are questions in the chat. So yeah, we will, as I promised, we will have a Q&A session at the end of the webinar. And yeah, feel free to ask your questions. We will address them when we come to the Q&A section at the end. But we continue with the changes in the United Arab Emirates. And one interesting development is that a new guide was published by the Federal Tax Authority. The guide is called Determination of Taxable Income. And this guide, it continued the tradition that's followed by the Federal Tax Authority in the United Arab Emirates, which was followed over the last year or so, where they published clarifications and guidances on the newly introduced corporate tax. And this is very helpful. Among those guidances are a guide for the free trade zone persons and on participation exemption, for example. There are over 10 guides, and this is very helpful. And this new one is really interesting. It's as comprehensive as most other guides. In particular, it has over 100 pages. And this is a methodological document which provides the view of the federal tax authorities how to calculate taxable income, how to arrive from income from profits reflected in the financial statements to, first of all, corporate tax base, and then how to calculate corporate tax based on the corporate tax base. This new guide has very interesting case studies, and for me personally, this is the most interesting part of such guides. There are 9 detailed examples which address deductible and non-deductible expenses, interest deduction, carry forwards of losses, and cash method of taxation, for example. And the guide, as I said, is very comprehensive. There is no possibility to review it in any detail in such a short webinar. But just to illustrate how helpful it is, let's talk about one specific example on unrealized gains and losses. So first of all, the basic principle is that in the United Arab Emirates, corporate tax is calculated based on financial statements, and financial statements are prepared in accordance with the accrual methods of accounting, and this is followed for tax purposes as well. But it is possible to tax certain profits not on accrual basis, but when they are realized. And this is addressed in a specific clause of Article 20 of the corporate tax law. Specifically, profits and losses that are related to assets and liabilities that are either recognized at fair value or recognized on so-called capital account can be taxable, well, deducted or included into profits in not on accrual basis, but based on cash methods of accounting, based on realized basis, which is fair because, for example, if you have a loan or an investment that is revaluated, but and loan, for example, can generate foreign exchange differences. Until the loan is repaid, you can face somewhat unpredictable taxation results. Foreign exchange gains or losses basically by default are included on accrual basis into the taxable income of a company in the United Arab Emirates. But this rule allows to include certain profits and losses related to assets, to specific assets and liabilities based on realization methods. And there are two different provisions in the corporate tax law, either to tax based on realized methods those assets and liabilities that are recognized at fair value, or apply these realization methods to assets and liabilities which are held on so-called capital accounts. And this term basically means that those assets and liabilities should be long-term, should be parts of non-current assets and liabilities, and in which case this specific method of accounting can apply. And the case study in the guide has this detailed description of a particular situation, and just on this slide you can see how even beautiful it is, where the tax inspectorate, the federal tax authority, they describe the situation. They provide a diagram of investments of a company in the United Arab Emirates and quite a detailed table with calculation of corporate tax liability. What can be seen from the guide and from this case study? Let's look at the example, at this specific example, and what types of assets and liabilities it classifies depending on the selected method of realization basis of accounting or realization basis of taxation. So let's move on and look at specific types of assets and liabilities and how they are classified. So, for example, the guide, the case study tells that there is unrealized gain on land. So the land is revaluated based on fair value each year, for example. And as you can see, it will fall under both definitions. First of all, if this is fair value accounting, then it can be the election can be made to treat it for tax purposes on realized basis, and the gain on the land plot will fall under the definition. And if this method is chosen, and there are two, if this method is chosen, the unrealized gain on lands will be eliminated from the calculation of corporate tax based on this provision, fair value of accounting. Alternatively, given that land plots are non-current assets usually, and in this specific example, unrealized gains on lands will also be exempt from taxation based on the other methods, on the method of taxation of realized gains and losses of assets and liabilities that are considered as non-current. Next, loss on inventory. Inventory is not a long-term asset. Usually, it is classified as a current asset, which will mean that only fair value of accounting methods or fair value of accounting item election will allow not to tax or not to deduct in this particular case loss on inventory, loss on impairments probably of inventory. If the other method is chosen, and the taxpayer will have to decide. And this is important point. In the first tax year, which for most companies will be 2024, the taxpayer will have to make an election, either to use one or the other, or not to use the realization methods of taxation of unrealized gains and losses, not to use it at all. And this, the guide specifically says that if no election is made, then this is also a decision. And then this decision should be followed basically throughout the existence of the company. That since it hasn't elected to use one or the other methods of taxation of realized, of taxation of gains or losses on a realized basis, then it should base its tax return on the accounting on the accrual of these gains and losses. Okay, so inventory only falls on the one item, non-current. Unfortunately, since it's a current asset, it will have to be taxed on accrual basis if fair value or if non-current assets and liabilities is used as a basis for realized basis of accounting. Next, impairments or revaluation of shares and the payments of investment of a UAE company in its subsidiary. Again, this is fair value of fair value accounting, and at the same time, this is non-current assets, usually investment in subsidiary, in which case both elections will result in realization methods of taxation of this loss. While long-term loan only usually falls under definition of a non-current liability, but it's usually not regulated based on its fair value. This is why the election, depending on the election, it will either be subject to taxation on realization basis or not. And finally, dividends. Dividends, they fall under both definitions. And strictly speaking, dividends, they are provided in example, but they are not considered assets altogether. But regardless of the choice, given that in this particular case, dividends were subject to participation exemption, they're going to be exempt regardless whether one or the other election is made or if no election is made at all. And this is, yeah, as you can see on the slide, both dividends and impairments of shares of investment in subsidiary are likely to fall under the participation exemption. Again, if conditions are just satisfied, but they are likely to fall under participation exemption, in which case, regardless of the election made or not made at all, they are not going to be translated from financial statements to the company's tax return. Okay, so what to consider given what we discussed before the year ends? Given that there is a choice that the taxpayer can make on the election of taxation of unrealized gains and losses, it makes sense to consider tax burden for 2024 in 3 scenarios. If your company pays corporate tax in the United Arab Emirates, then you can consider before the year ends what election is beneficial or no election at all. You will have time until after the year ends to decide and make the election. But yeah, it's better not to be delayed to make this choice. And 3 scenarios are should be compared to make the choice. And again, since many companies are subject to taxation in the United Arab Emirates, special free trade zones are subject to 0% corporate tax, it makes sense to assess whether your company in the United Arab Emirates, which is registered in the free trade zone, is eligible to this exemption. And before the year ends, before 2024 ends, make changes to whatever can be made in order to improve your chances to apply the exemption, the 0% corporate tax rates in the free trade zone. Okay, now this is the final section, and we will turn to questions. And the final section about global trends. We'll only briefly mention a few trends outside the countries that we considered up to now. One thing that deserves attention is developments in Hong Kong, and we see that the recently introduced foreign source income exemption and its practice, its interpretation by the tax authorities, by the Inland Revenue departments in Hong Kong is changing, in particular in relation to interest and taxation of interest and application of foreign source income exemption in Hong Kong. There are some developments which basically make it more difficult to apply exemption to interest income in Hong Kong. Next, Mauritius is a country which we see more and more often in structures that we work with, and starting well, a few months ago, a new corporate climate responsibility levy was introduced, and for most companies which have a financial year that coincides with the calendar year, this 2% corporate climate responsibility levy, this 2% levy will apply starting next year. It has some interesting features, and it's not always clear what income should be subject to this tax. But as we saw in practice, unfortunately, there are instances where even passive income should be subject to this tax, which may affect not only operating companies in Mauritius, which would be fair, but also investment companies, which mainly derive passive income. Okay, and finally, not to forget that Pillar 2, and one of its main features is global minimum tax rates is already with us, and starting 2024 in many countries, specifically in Europe, it already applies, which means and it applies to companies that have consolidated revenues exceeding 750 million euros. And if your company exceeds these thresholds, it makes sense to consider whether your operations and your ultimate parent company will be subject to additional tax burden in connection with this new rule, with this new this Pillar 2 requirements, which many countries have introduced starting this year. Okay, this is it, and we probably already run out of time, but we will spend a few minutes to answer a few questions. And I will start by answering Elizaveta's question, which she typed in our chat. And the question is, will the reduced 5% rates also apply to the entities from the blacklist jurisdictions? And this relates to Kazakhstan, to discussion in Kazakhstan about the plan to reduce the domestic tax rate for dividends to 5% from 15% for those non-Kazakh companies that hold at least 25% share in their subsidiaries in Kazakhstan. Well, the short answer is no, meaning that no exemption, no reduced rate is available for blacklisted for investors from blacklisted countries. For example, Hong Kong is still blacklisted by the tax authorities, by the Ministry of Finance of Kazakhstan. And if investor receives dividends from Kazakhstan, usually if the investor is located in the blacklisted country, then this investor have to suffer an increased withholding tax rates in Kazakhstan. The domestic rate for most income is 15%, for most passive types of income is 15%, but it's increased to 20% for blacklisted countries. And the new 5% exemption is the new 5% incentive is no exception. And yeah, the answer is that unfortunately it doesn't seem that it's going to apply to investors from blacklisted countries. Yeah, this is the answer. Okay, we also have a question which I will read out and then ask my colleagues to join me to answer it. This question we received before the webinar from one of the registered participants, and the question is this: if a company from the Astana International Financial Center is the only owner of the Russian закрытый пив недвижимости, or закрытый пив, which can be translated as closed unit investment funds. So this Russian funds distributes dividends, make distributions to the participants in the Astana International Financial Center. So at what withholding tax rates will interim distributions from these funds to the company in the AIFC is going to be taxed? And in brackets, the participants clarifies or adds, consider simplified limitation of benefits and MLI. Okay, this is an interesting question. I will start, but do I have my team with me just to?
Yep.
Just in case
we all here.
I need your help. So I think the first step to answer this question is to consider domestic treatments of this type of distribution. And for a long time, unfortunately, distributions by funds, by unit investment funds in Russia were not specifically classified for withholding tax purposes, but it changed a few years ago, and now it is more or less clear that interim distributions, they should qualify as dividends, which means that the 15% rate, as we all remember, which is going to be maintained at this level next year as well, the 15% rate is going to apply based on domestic rules, right? But we will have to consider the double tax treaty between Russia and Kazakhstan. I will start again. First of all, those companies which are registered in the Astana International Financial Center are not. They can also rely treaty benefits. They are not denied from application of tax treaty benefits, which is why the double tax treaty between Russia and Kazakhstan is going to apply. And maybe, Vsevolod, would you like to continue?
Yeah, I was able to recently find a clarification from Ministry of Finance, and this clarification relates to the double tax treaty between Russia and Armenia. And Ministry of Finance, they actually dive deep into almost the same situation, and they were able to come to the conclusion on the basis of the commentary to the OECD Model Convention that for the treaty purposes, the distributions from Russian closed PIFs should also be considered as dividends. So as Victor told, companies from the special center in Astana, they can apply the beneficial rates from the double tax treaties just as regular companies in Kazakhstan. So from this perspective, it means that if only we had no MLI, we would be able to use the beneficial rate for dividends from the double tax treaty. As for the MLI, Victor is obviously better specialist in MLI than me, but as far as I remember, the SLB means that there are a short list of persons or entities who are actually entitled to the benefits from the double tax treaty. And there are such persons as natural persons, individuals, public companies, and some other, well, straightforward entities and bodies who are obviously are entitled for the benefits. I remember there were also one paragraph which told that it may be a company who has participants listed above, meaning again those straightforward, well, entities and persons such as individuals and public entities. So I would say the following, and Victor obviously will be able to add something to my answer, that we should look not at the Russian side where the closed personal income fund is, but at the other side, at the recipient side, because we have to analyze who is standing behind this company in Astana Center, and whether or not we will be able to apply the beneficial rate for dividends with regard to SLB rules.
Yeah, I totally agree, and I think this closes off our discussion nicely. That each situation is unique, and we have to consider all facts and circumstances. And this is what we do as consultants. And in this particular situation, as Vsevolod said, we will need to know more to decide whether a simplified limitation of benefits in the Russia-Kazakhstan double tax treaty allowed to apply the reduced withholding tax rates. But my impression is still that this concept is only developing in Russia and in Kazakhstan as well, and in other countries. And I haven't seen many instances where this concept was applied in practice. This is why we will only, in some cases, have to interpret what is written in the treaty. But we do not know how this is going to be applied in practice. But nevertheless, each situation is unique, and I'm never tired of saying that it should be considered with all relevant facts and circumstances, and this is what we do. So I think it's a good point where we end our discussion, and we run out of time and questions. We answered all questions that we received, and it was really a pleasure to be with you all this 1.5, even more hours. And this is it on my end, at least. And I can only I can only say that have a good and productive rest of the day and the remaining parts of the week.
Thank you. Thank you for joining us.
Yes. Thank you. It was a pleasure. Let's keep in touch.